What's your view on the CPI print later on today? Is this the data point the Fed needs to hit pause on the rate hike cycle?
First of all, Dan, thank you for having me on the show. It's a pleasure to be here. In our opinion at Golden Equator, what we think is the CPI number has been continuing to trend down, and today's number should be no different. We continue to see pressures coming from core food prices, energy prices, a slightly edge higher, and over the summer spending might push it. So while we expect numbers to come in line, there is a possibility of a slight upward move as consensus have been pricing it for this month.
Vishal, when it comes to market positioning, you are defensively positioned right now. I'm curious to get a sense from you about where you see markets moving from here. Do you see perhaps a more deepened stall in some of the gains that we've been seeing in equities, or even a recession coming, at least in the United States? What's your view?
You know, I think it's a very interesting market for investors today. It's a very exciting time to be an investor because there's so much bifurcation that's happening between the stocks and bond market. If we look at where yields are for equities, they're north of 5%, and that's also where bonds are. And that's the last time that happened was in 2002 and prior, between 94 to 2002. And your real interest rates have actually gone higher than your real growth rates, and for us that tells us that the economy should start to slow because your hurdle rate now has increased much further than where the growth is. And from that perspective, given that there's not much appreciation from a earnings yield perspective, and the market's pricing purely on growth, we think that there needs to be a pullback in markets to reprice the slowing economy that will have to come out in the next couple of quarters.
Okay, so what is that pullback going to look like if it eventuates?
I think the first target for us is where the 200-day moving average is for the S&P 500. We think that, you know, if you're in defensive sectors, they can still hold up well because we expect the Fed to take a pause and reassess where inflation is, especially if it heads lower and closer to targets, because that will push real yields up. So if you look at the 200-day moving average for the S&P 500, that's about 10 to 12% pullback from where it is today. And I think from there, the markets can reassess. But I think there's a bigger problem brewing. You look at the way the U.S. has been spending, and I think you touched on this just before, and that's around 8% of GDP that's been spent last year as a budget deficit when unemployment's at 3.5%. I think that policy is something that's somewhat imprudent. They should be shoring up their balance sheet rather than spending a lot more. And just from that perspective, you might have, and you've had a good kick from fiscal policy this year, but that drag will come at a time when QT is happening and when rates are so high that the first target may be the 200-day moving average, but it's very possible that we break that if conditions become worse.